If you think banks make decisions on credit scores alone, that belief in itself is costing you access to capital. Credit scores are not a decision engine, they're a filter, not a verdict. So, what's the difference? When I say filter, what I mean is this is an opportunity for banks to have an immediate eliminator or qualifier worth viewing the application at all. We're going to dive deeper into this topic, and I want to make it clear. I see clients with high credit scores get denied constantly. On the flip side, I see clients with moderate credit scores with the proper structure get approved on a regular basis. You'd be astonished how often this happens. So, I want to start by giving you a four pillar framework on how banks are actually assessing the totality of your relationship as well as your lending requests. So I'm going to be going into my notes as I always do in these videos to keep everything sharp and to the point. But I want you to pay attention and take notes along the way and drop any questions you have in the comment section down below. So let's break this into four pillars of how you're actually scored internally by banks, okay? Cash flow behavior, account structure, product depth, relationship history. Okay, none of those things are credit scores. They can influence it indirectly, in some cases directly, but they aren't inherently credit scores. Does your credit score matter? Absolutely. But once you're in a certain bracket or threshold of being qualified to be viewed or accessible at all, this is going to be the information that really makes the difference in getting approved, how much you're approved for, and the attractiveness of the rates and terms. Let's dive into these four really quickly. Cash flow behavior, money management, inflows and outflows. Are you overdrawing? Is there a surplus left on a monthly basis? Is there consistency in your behavior with your cash flow, or is it erratic and is it spontaneous? This is how you're being measured. Banks love boring consistency. I say that often. Cash flow should not be a fireworks show. Next, account structure. Do you have the appropriate accounts that you need to manage your financial affairs? You have a checking and no savings, savings, no checking, checking in a credit card. Do you have what you need? Do you have the proper structure when it comes out to the various accounts you're using to meet your cash flow and financial needs? Very important. This shows just basic level of responsibility on your end as a client and as a borrower. Product depth. This is one that gets slept on a lot. Product depth is okay, you have a checking account, but are you using the online banking? Are you using the credit score, credit monitoring? Are you using the budgeting tools that come along with the account? What are you using? If you have a savings, are you setting up automatic savings transfers? What are you using once you get the relationship set up initially? Are you using the additional tools and resources that come with the accounts to optimize the use case of those accounts? Yes, banks are paying attention. Yes, it can influence how you're scored internally. Relationship history should go without saying. You've been banking here since whatever window of time. Have you actually established a relationship over that period of time? You have people who are at financial institutions with just an account or two open, barely use it. Then they walk in one day and really need something. And the bank's like, no, sorry, we don't even really know you. Because at the end of the day, you haven't actually developed a relationship. I didn't say account history, banking relationship history. Big difference. So let me give you a real world example, or at least a synopsis, right? So high score, low relationship client. Average score, strong structure client. What is a quick example of what that looks like? High score, 760, 780, basic checking account, doesn't use it, or checking and credit card, but erratic usage on a credit card, erratic payment history from the checking account. Maybe you have a checking account, you don't have direct deposit set up, so there's no consistent inflows coming in. That's an example of a poorly structured relationship on a client side that may have a great credit score that can still get denied. Average credit score, strong structure, 640, 660, 680. Multiple products, all synchronized, they all make sense. Consistent behavior on the cash flow. product depth. They're utilizing the fraud protection. They're utilizing the credit monitoring. They're setting up automatic transfers from checking to savings and building a cushion for themselves and reserves. Totally different client. As long as that 640, 660, 680 isn't a blatant disqualifier, right? Late payments, recent charge-off collections, things of this nature, obvious rough stuff. But if that 640, 660, and 680 is from a thin credit profile, a little bit of higher utilization, but nothing too crazy. Like if it's from too many inquiries in the last 6 months, these are things that can be navigated around with internal scoring models and having a strong structure with the financial institution. So some quick actionable steps that a framework or moves you can make that will show you how to make yourself valuable before applying. Stop doing what hurts your internal scoring and position yourself for future approvals. We already went over the bullet points of how you're measured at the top. So the moves need to be consistent, steady cash flow, ideally focused in on one institution unless you have the means to spread yourself out to multiple. No erratic behavior, spikes in deposits, no activity out of the blue, big transactions, spike in deposit, no, too much fireworks. Keep it simple, keep it steady, maybe keep it notching up a bit. Nothing crazy. Banks don't like that type of excitement. Structure your accounts effectively. Make sure that you're showing them the entire ecosystem of your cash flow. That's what account structure is about. I have a direct deposit coming in. I got some expenses coming through. I got excess cash flow. Some of that excess cash flow is automatically transferring to my savings account. I'm using my credit card for most of my regular everyday expenses and paying it off out of my checking account. I got a whole little symbiotic ecosystem going on. Things that are hurting your internal score, not using a relationship, not using the products frequently, having accounts, you're opening and closing accounts too frequently, fraud claims too frequently, just all kind of erratic behavior, inconsistent, high risk, low profitability behavior hurts your internal score. Set yourself up for future approvals. They're going to be looking at what when they pay attention to your lending requests. Obviously, your credit score is going to be a factor, but that aside, credit profile. That aside, internal banking behavior, cash flow, income, inflows, consistency in these departments, steady income from a steady job, not overdrawing your account, spending money you don't have, managing, using the products and tools to navigate and manage your personal financial ecosystem, setting up a relationship with the actual institution, like an actual banker, and leveraging that relationship. They're going to be looking at all of these little details. Now that the data is all carved up for them, the era we're in today, these are the things that you do or don't do that are going to set you up for future approvals. So if you want to understand how banks actually think and not how they advertise, subscribe to this channel. This channel is for individuals looking for real leverage. Comment down below and let me know your thoughts and curiosities, your experiences around setting up quality relationships with your bank and how it's improved your access to capital. Let me know if you have an experience where your credit score wasn't the best, but your relationship pushed you over the hump. The internal score that you set up pushed you over the hump with that financial institution to get better results. Maybe you were approved for multiple credit cards at once, or auto loans, business funding, whatever the case may be. Comment down below and let us know your experiences. If you had some bumps in the road and you learned something, comment down below. So all my pioneers, welcome back. To my new viewers, welcome in. I want you to like, comment, share, subscribe, support the channel so the channel can continue to support you. Get in the description section down below and time with me on Instagram and TikTok. Also, for those of you who may be new to the channel, I am an active banker by trade, financial services professional. I've been in the field for over 14 years at the time of this recording. I have a client relationship book of about $25 million between deposits and investments. That's between consumer and small business clients. I have a mortgage loan originator's license, life insurance license, FINRA investment license, as well as small business banking certified. So you're getting this information from somebody who's taking these same principles, concepts, information, news, applying it to my clients and helping them to increase their net worth and grow their businesses. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.